Okay, hello everyone. It's me again. I'm going just to cover in this video. I will try to split them into separate videos just to avoid the long videos. I will cover in this video learning outcome or the lecture objective or learning outcome number 3. Explain the basic of life cycle cost management and target costing. Of course, by the time you watch these videos, you will find all the PowerPoints of this PowerPoint slides for this topic will be available on on Moodle. As I mentioned, I'm not going to go over the PowerPoint slide one by one. But I will just I will make them available to you for your reference. So in this particular video, I will focus on the first type of the calculation questions, which related to target costing, lean and target costing. And then basically uh, with this kind of type of questions, we really need to move to the life cycle cost and life cycle cost management and link this to target costing. I think in the topic of environmental, if you remember, if you go back to the lecture notes and lecture videos of the environmental topic, the second one, the environmental inventory analysis, etc., the second part of the inventory of the environmental topic, you will find some slides on the product life cycle and life cycle assessment, and how I explain this was on videos and by calculation or numerical question, etc. So just to recap and remind you with what product life cycle is, it's the time of the product exists from conception up until abandoned. Life cycle cost is all the cost associated or linked or assigned to the cost of the product life cycle. So it's a set of activities required to design, develop, produce, market, and service any product. So it's the marketing process of the product. We always say, yeah, this is the activity, this is the design, this is a develop, this is produce, this market. So this is what we mean. During the development stage, there is always, some costing, although it's development, but there are some costs available on that. So some researchers just classified the product life cycle and compare this between the normal product life cycle and a whole product life cycle. So the product life cycle is product of the planning, design, testing, the product manufacturing, logistic, including advertising, distribution, warranty, etc. However, the whole life cycle of the product, including all of this, which is the planning, designing, testing, manufacturing, logistic, plus customer post-purchase cost, because as you know, that of course taking into account the sustainability and the corporate social responsibility and the recycling and the upcycling, all of this is what they are doing, what customers are doing after the cost purchase. And also this is including the warranty and including repair and including everything after they got and after they gained the product, after they bought the product, after they paid for the product. So this is what we mean by product life cycle versus a whole product life cycle. What target cost means? Target cost means the difference between sales price needed to capture a predetermined market share and desired pre-unit profit. Of course, I know that you don't understand a word from that, but it does make sense. It will make more sense after we do the calculation question, and I will bring this back to read it. So the question here, it says the company has two products. Manufacturing a product with life cycle that average 4 years. So they are producing something for 4 years. The first year cover the product development stage, and the next 3 years cover production and sales. So we having here a product life cycle in which In the first year, they cover the development stage. In the next or the following 3 years, they covering the production and sales. A budgeted life cycle income statement developed for the two products. And I give you here product A and the product B and the total column. I give you some information about sales for each product, cost of goods sold for each product, gross margin for each product, and then traceable fixed costs or traceable expenses. I hope you remember, traceable fixed cost and document fixed cost and gross margin, contribution margin. We'll go back to this later on. R&D is abbreviation for research and development. So research and development is 1,000 for the whole company. Marketing is 575 for the whole company. And the life cycle income is the difference here, which is 675. We'll go back to this later. And also, also there are some extra information available to you. Gross margin has been set to be 50% of the two products. The company reckoned that there is a little scope of increasing the process and is relying on market beating post-purchase cost to give it competitive advantage. However, as a performance indicator, the company required 20% as a return on investment in these products. Assume that product A, that period expenses that traceable to each product, that product A will be responsible for 60% as research and development. So research and development here is 1 million. Product A is responsible for 60%. And the 50% for marketing. So product A will be responsible for 60% for research and development and 50% for marketing. Prepare income statement for each product, calculate return on investment, calculating, and then calculate target costing. So as usual, this is a question, and let's move to answering this particular question. Here it is. It is from the question here. I will just try to make it more kind of bigger. So sales, I will put here, sales take away the cost of goods sold, because of course we are dealing here, this is a kind of, basic sales take away the cost of goods sold will give us gross margin. So gross margin is the difference between sales and the cost of goods sold. And then when it comes to traceable fixed costs or traceable expenses, there are some instructions in the question to say that 60% of product A responsible for research and development, 60% for product A. That means that the other 40% will be for product B. And for marketing, 50% for product A. That means that the other 50% will be for product B. So let's move and do this calculation and understand what does this mean. So based on that, we have sales 2 million for product A, and sales for product B is, I think I will try to make this bigger. Okay, sales for product A is 2 million, sales for product B is 2,500,000. The total is 4,500,000. This is of course from the question, copy paste from the question. Cost of goods sold again is copy paste from the question, 1 million. This is a piece of information I provided to you in the question. Cost of goods sold for product A 1 million, for product B 1,250,000. The total is 2,250,000. Gross margin is the difference between sales and the cost of goods sold. That means in product A we got 1 million. For product B we get 1,250,000. The total is 2,250,000. Okay. Traceable expenses. Traceable expenses, we give you here 1 million, right? And it was explained to you, or we provide you some information to say that 60% of the research and the development allocated to product A. So 60% of the 1 million this should be 600. So where I get the 600 from is 1 million times 60%. I hope this is clear. So 1 million times 60% will give you the 600, right? And then that means if product A allocate, if research and development a figure and 60% of this figure allocated to product A, that means the rest will be allocated to product B. So if we got 1 million as a total research and development, 60% of that for product A, that means the 40% will be for product B, or the leftover will be for product B. The same concept we can implement in terms of or in relation to marketing. Marketing was 575, but the instruction says 50% for product A. That means the other 50% will be for product B. So if we just calculate the 50% here, 50% for product A to 87.5 and for product B to 87.5. Total cost, including research development, marketing, this will give you the total cost for product A 88700 and 887.5, and for product B 687.5, and the total is, of course, you add them together, 1,575. Life cycle income is, to get the life cycle income, is sales take away all these costs. So the gross margin take away all the costs, all the traceable expenses. So we've got here gross margin 1 million, take away the total cost, which is 887.5. That means the life cycle income is 112.5. The same for product A. B, the life cycle income will be 562, and the total is 675, right? Return on sales. To get the return on sales, here, return on sales, how we calculate the return on sales is the life cycle income divided by sales, even from its name, ROS, return on sales. That means we take the income, which is here, the income here is calculated based on the life cycle of the product. So the life cycle income divided by the sales will give, and of course calculate the percentage, will give us 5.6 for product A, 22.5 for product B, and 15% for the whole company. Okay, I think you know what you expect, or what is the next question now. Okay, you have this in front of you in the final exam, and I ask you to do this very simple calculation, just allocating 1,000 or 2,000, 60, 30, 30, whatever, and then comment on the results. Okay, so to comment on the results, first of all, you say that based on the information available, that means based on the information available, product B is more profitable than product A, because product B achieved 562.5 life cycle income, comparing with product A, which only achieved 112.5 income. Or you might say product B is more profitable because return on sales in product B is 22.5, comparing with 5.6 only a return on sales in product A. Okay, this is an opening comment, but I really, of course, I'm always asking for more. Okay, this is the main comments. Give me more information. Why do you think product B is more profitable than product A based on the information available to us? I'm not asking you to go and collect more data under final exam situation. You only have this information in front of you. So just tell me, what do you think from the information available to you? Why do you think that product B is more profitable than product A? Why we get these results? Okay, so I will start from the beginning. I will start reading behind, what's behind from the beginning? I would say here, product A, product B achieved more sales, right? So product B sell more than product A. So the product B sales is 2,500,000, product A sales is 2 million. However, the cost of goods sold for product B is 1,250,000, while product A is 1 million. Okay, so the cost of goods sold for product B is more, right? If we move to research and development, because the core here is for the traceable expenses, research and development and the marketing. Okay, even from its name, research and development, right? Research and development, that means we do research and development for new products, right? So if the company here investing 60% on research and on development in product A and 40 in product B, we would assume, or from this piece of information, we might assume that product A is a new product and the product B is an existing product. Does this make sense? Because they invest more money on research and development. So they don't have a clue what the product is. So they spend more money on research and development. That means they don't know about the product. So we take this information, we translate this information, we interpret this information as product A might be a new product and the product B might be existing product. Hang on for a second. If we assume that product A is a new product and the product B is an existing product, how on earth the company invests 50-50 in marketing? So you might say, although, or we assumed that product A might be a new product and the product B might be an existing product, but it might be the company wants to keep product A to sell more, or keep product A keep product B, which is the current product, to be in the market and sell the same. So they invest the same marketing expenses in both products. This is how to analyze things. So we came out that yes, product B is achieving more return on investment because it might be an existing product, and the product A because it might be a new product, and this is why this is happening. So I really need you to analyze the way like that. It might be some other students might say, hang on for a second. We might, because here sales take away the cost of goods sold, we give here this particular company implemented gross margin. Okay, and we know that there are two ways or two methods of implementing that or of presenting that. There is absorption method and the absorption costing and the variable costing. Absorption costing, that when we get we get the gross margin. So the absorption costing, when we include both variable and variable costs and the fixed costs in the cost of goods sold. So the cost of goods sold, including both the variable and the fixed cost. This is why we got gross margin. However, under variable costing, companies only include the variable cost dimension or items in the cost of goods sold. So one of the comments, it might be, you might say, the company here implemented gross margin, and this is why we got this result. However, if the company implemented the variable costing approach instead of the absorption approach, and in the variable costing approach, they will get here, the difference will be contribution margin rather than the gross margin, we might have get a complete different results, because we don't have a clue. We don't have a clue what's included in this 1,000 and what's included in this 1,000, 1 million and 1,250,000. Okay, so to sum up, you have to use any piece of information provided to you. So we discussed it might be this result or product B is more profitable than product A because it might be the variable costing versus the absorption costing implemented. And the variable costing, absorption costing leads to gross margin, while variable costing leads to contribution margin. It might be product A is a new product and the product B is an existing product. It might be the company, although product we assume or we accept that product A is a new product and product B is an existing product. It might be the company wants to continue with the current product or the existing product, and this is what we can get as a comment. Okay, so this is the first part. You calculate the return on investment, and then second part of the question, we get sales, which is 2 million to 2,500,000 and the total. And then there is a required in the question, it says return on investment is 20%. I think it was mentioned somewhere here. I will try to show you. Yes, here it is. It says here the company, the return on investment is 20%. So what we really need to do is just getting sales. Give me 1 second. So sales 2 million, and for product A 2,500,000 for product B, 4,500,000 for the total. And the required rate of return for product A, we should just calculate 20% of the sales. So 20% will be 400 of sales, and 20% of the 2,500,000 will give you 500, and the total is 9,000. Okay, the total target costing is the difference between sales and required return, the return on investment. So target costing is the difference between sales, take away sales multiplying by the return on investment, and this is the target costing. If we go back to this, what target costing is the difference between sales price needed to capture predetermined and the desired per-unit profit. This is what we mean by target costing. So when any company calculate the target costing, that means they put sales and they put the required rate of return from sales, and the difference between the figures, this will be the target costing. I hope this makes more sense now. To be very honest, if you sorry, I never ever memorize any information, any terminology, or any concept. Sometimes, because this is very difficult, this is something that a definition, a proper definition, academic definition. So sometimes when you know the concept, you know what it is, you know where you get it, how to get it, just explain it in words. So target costing is the difference between sales, take away sales multiplying by the required rate of return, the percentage of required rate of return. Even if you explain it in kind of very simple words with a very simple example, this is more than enough. Okay, and then once we calculate the target costing, we just kind of take away all the traceable expenses. And I'm reminding you, and this is why I've put this here as with yellow. When you do in the second table, because in a question like this, you have to produce two tables. One table for to calculate the product life cycle and calculate the return on sales, and the other one to calculate target costing and just to get the difference between both of them, to calculate profit as well. But with the target costing one, once you calculate the target costing, just list all the expenses, but the first item should be cost of goods sold. And this is why I highlighted it yellow, because again, under final exam situations, students miss cost of goods sold, right? And then you add research or you list research and development, marketing, you add all of them together, and this should be the total expenses. Target costing, take away the total expenses, will give us the same kind of results, that product A is more profitable than product B. Sorry, product B is more profitable than product A. And you have two options. When I say comment on the results, you might produce the two tables and then provide a full comment on both tables, or you might prefer to provide comments on each table together, in each table separately. So for this one, you might explain the comment by listing or discussing what happened in, or how you calculate the target costing, and how the traceable fixed cost, including cost of goods sold, research and development, marketing, affecting the results of achieving more profit for product B comparing with less profit or loss for product A. Okay, I think I will stop here, and I will see you in another video.